Okay, so I'm going to assume you've read it now, and I'm going to proceed under that assumption. I'm presenting just one table. You'll see I'm just presenting table 6. I just want to sort of get at the crux, the central idea of this paper. So in an exam setting, I would probably have 1 or 2 multiple choice that relates to this, or maybe you'd have the opportunity to connect this to a short answer problem, or maybe even the business article. I'd say, how does Kremer's Petagisto relate to this problem that I proposed, or something like that? How could you use their methodology, or what might you infer if you got certain results? So be able to sort of think about the theory of this paper. Okay, so the first idea is they are looking for a signal. They are looking for a signal of quality of managers. Signal of quality of fund managers. Why are they looking for that? Because if you ask managers, are you good? Okay, we have 2 kinds of managers. Okay, so this guy's secretly bad. And this guy's secretly good. We can't see this information. They will both say, I'm good. All right. So the question is, how do I separate these two? I do not actually want to invest in this guy. But if I ask them their opinion, are you good? They're going to say, yes, of course I'm good. And I'm going to say, but I don't believe you. Prove it. So how can I construct a signal that would separate these two? Kremer's Petagisto makes the argument that a truly good manager will not exactly behave the same way as a bad manager. The same way as a truly good student will go through a degree and pass, whereas a person who claims that they're a good student will not necessarily pass through the degree. A truly good manager will do something that a bad manager can't, and their argument is they will be active. Okay, that is in the context of what we learned way back in probably the first or second week of class, active management. Okay, and so this makes it strange because we've talked a lot about the results that we find active managers can't pay their own wages back. But just hold with me for a second. Let's talk about the argument as to why this happens. You can imagine a situation where, let's say in the last few weeks, the market could go up or the market could go down. Okay? And let's say your own fund, I'm going to create different situations. Your fund could go up or your fund could go down. I just want to clear this space up. So actually, I probably won't even want to draw it that way. I want to make it a little bit clearer. Your fund could go up and your fund could go down. Okay? All right. So if the fund goes up and the market's going up, your benchmark's probably going up too. So your clients are probably okay with you. Why? Because you're not losing money. The competition's not losing money. They have every reason to believe that you're talented. If, let's say, instead the market goes down, but you go up, your clients are probably very happy with you. Somehow you've made money in the last couple of weeks. When the broad market's headed down, you've made money. If the market goes down and you go down, you'll claim tough times. You'll say, look, it's true I lost money. I'm sorry, Mr. or Mrs. Client, but it's hard to perform well. And your client may be slightly annoyed with you, but they'll be roughly okay because at least they can't think of anyone who's doing better than you. But the problem you encounter is a situation if the market goes up and you go down, they're going to be pissed off. They're going to be seriously annoyed at you because in this case, it's evident that other people could make money and it's evident that you didn't. And this is when you're going to see redemptions and cancellations of placements. They will try to get away from you. Okay, so think about as a manager that knows you're bad. Okay, if I am a bad manager, okay, and I'm scared of this possibility because I know it. I know it myself. Okay, I'm a lousy manager. I know it. I don't want to admit it. I'm going to try to avoid this situation. How will I avoid this situation? I need to avoid losing money when everyone else is going up. So what if I decide, for example, to just sit on an ETF? Okay, for argument's sake. If I sit on an ETF, then it's reasonable that when the broad market goes up, I'll go up with it. And when the broad market goes down, I'll go down with it. And so what will happen is I will either get this outcome, the market went up and so did I, or the market will go down and so will I, but I'll get this outcome. And the ETF, I'll basically just jump between these two possibilities. Okay, I do not take any risk in this sense that I will just sort of pony, hitch a ride, on the broad ETF. And now when times are good, I say, hey, look, I'm keeping up with everyone. When times are bad, I say, well, yeah, it's true. I'm suffering, but so's everyone else. And my clients will probably go somewhere from okay to okay. They'll never fire me. It's true I would like to make them happy if I could, because then I could possibly attract new capital, pay myself a higher pay raise. But this scares me. And this scares me because I don't trust myself enough that I can avoid this situation. Now, think about it from the perspective of a higher quality manager. A higher quality manager says, yes, these things are concerns, right? But, yes, these things are concerns, but I am confident that I can do this. That when the market is down, I go up, and I can confident I can stay here. That I'll either go up when everyone else is, okay? Which means that to achieve this, I have to break away. When the market's going down, I can't hold the same thing as the market. I can't be holding the ETF. Okay, I've got to do something, and I've got to shift away from the ETF, at least in the cases where it's down, or have a strategy that when it goes down, the ETF or the fund that I'm holding naturally performs better. And so a good manager will not want to sit on an ETF. That is, they will not want to be passive. They don't want to be passive because it will only deliver them average results. They will want to be active to distinguish themselves. And so what we can do is we can now say, look, activity is a risk to the manager. Being active exposes you to criticism. And so only the managers who are confident that that risk of exposure will be the ones that will engage in it. And so we now have that active management is a costly signal. And importantly, that costly signal has heterogeneous costs. Heterogeneous means different amongst people, or different amongst different genuses, like a group. Hetero means different group. So heterogeneous costs means the cost of being active differs by individuals. I slipped over it a little bit too quickly, but the point on the education situation that I gave you, like my brother, it's not that I found school terribly fun, or that I like paying tuition, or I like delaying my career. It's that those things were less painful to me than they were to my brother, and therefore I found it less expensive to go to school on a psychological basis than my brother did, and therefore I could go further and distinguish myself more and then reap the rewards of that signal. Okay, it's not that you guys pay no tuition or that you like group work. That's not what we're arguing. We're arguing is that you are more tolerant of group work, or that you have more financial capacity to tolerate the tuition or whatever, to signal yourself as being distinct. Okay, and so active management is always risky. The active manager knows that they could screw up sometimes, that they could end up accidentally disappointing, that the rest of the market goes up when they go down, and that would expose them. But their estimation of their own abilities is such that they think that that's a rare occurrence. Okay, and so what we could do is, if we can construct a measurement of activity, we could use this as a costly signal. We could use this measure and say, is there evidence that this active management signal, is this connected to quality? Our hypothesis is that high active management should connect somehow to high quality. Okay, and so that's what this paper's after. It's a nice paper, I think. It's a pretty sweet in that it uses signaling, which I like, and it's also related to funds, which is great. So let's go ahead and talk about their measurement and how they construct things. So the first thing they do is they take your stock fund returns. Okay. They take the returns of, let's say, ABC fund, and then they run a regression of, let's say, various ETFs. Okay, they try, let's say, a couple of ETFs, ETF 1 and 2, and here's the return of ABC. Okay, and so when we run this regression, we might get a pattern like this, for example, and maybe we get a pattern like this. And so when we plot lines, we see that this model is superior. And so what we would conclude is that it looks like ABC fund is most closely following the strategy of ETF 1. It's not that there isn't some positive connection between ETF 2 and ABC, but it's a little bit all over the place. And so what we do is we'd select ETF 1 as a benchmark for ABC fund. We'd say that it appears to us that ABC fund is most closely connected to ETF 1. So once we've done that, what we can do is we can take from the data available, they actually had fund data, they look at what composes these funds. So let's say there's 50% in Apple, and maybe 25% in Tesla, I'm exaggerating. And maybe my fund is similar but not identical because, again, it doesn't fit perfectly. Maybe I only had 40% in Apple, and maybe I had 30%. I had a tilt or a slight overweight relative to my benchmark in Tesla. Okay, and so what we could do is we could take the difference between these values. Let's say I've got 40% versus 50%. So I can take the difference in this, which would be a 10% allocational difference, and maybe the difference between the Tesla holdings. Okay, and what I'll do is I'll take these differences. So I have 40 minus 50, which is minus 10. And I have 30 minus 25, which is 5. And then the only problem is that you'll notice that every time I move weight from one thing, I have to move it to something else. So taking 10% out of Apple means it went to something else. So I don't want to double count. And the other thing is that I don't want to have negatives or positives necessarily be indicators of, they'd net out to 0. So what I'm going to do is I'm going to take absolutes. I'm going to take the absolute values of the differences and add them together. And I'm also going to take 1/2 that quantity because otherwise I'd be double counting. And so here we have their equation that they use for their measure of activity. They find a benchmark that they think is an appropriate benchmark that would be a comparison to your fund. The regression method that I described is one method that they proposed, but in the paper they actually use a slightly different technique. I'm not too nitpicky about this, just be able to describe the regression technique to me for the exam. And so we select a benchmark, and then we take the weights of our fund I versus the benchmark, and we find the differences. We take the absolute values to get rid of the signs, add it all up, and then take the half to avoid double counting, and we end up with a measure of active share. Okay, which will be somewhere between 0, meaning you are not at all active, you're basically holding the exact same thing as the benchmark, or 100%, which means you are really quite very different from your benchmark. Practically speaking, you can't get that far off, because if you did, you'd probably look like another benchmark altogether. But once they have the measure of activity, what they then do is they take the fund and they split it across 2 dimensions. Okay, so this is important. What they do is they take the funds and they break them up into highly active and very inactive, low active. Okay, or what you could say is basically passive down here. Okay, and then they break the fund up in that dimension, which is this is what the article's after. Okay, this is the contribution of the article here. Okay, but what they acknowledge is that funds can differ in another important dimension, documented in earlier literature. Not that this is their primary thesis, but because they're gonna encounter people complaining that what they picked up has already been known and was simply related to something else. And so what the other thing that was known before is size. What we've observed is that large funds, okay, the returns on large funds tend to be lower than the returns on small funds. Okay, why would that be the case? Okay, there's a couple of reasons. One is small funds have available to them strategies that large funds can't. As a small fund, I can buy venture capital companies, I can buy small growth stocks, I can buy penny stocks, and I can allocate to up and coming interesting investments and maybe put 2% of my allocation into, let's say, a growth stock, without it having too bad a distortion. If a large fund tries to put 2% of its value into a growth stock, it could end up buying the whole growth stock. And what could happen is it could cause what we call price impact. Okay, or in another sense, going back to the information conversation we've had earlier in this lecture, when I attempt to buy that stock, I push the price up. If I'm a huge company, I'm a huge fund, I'm trying to funnel enormous quantities of capital into a stock, I'm going to push the price up a lot more. People are going to detect this massive buying pressure, and what will happen is the first few shares I might buy would be a good deal, but I very rapidly, because of the small size of this target company relative to my size, what happens is I very rapidly push the price up to the point where there isn't much profit to be had, and that impact would be that it would reduce my return, my returns. My abnormal returns that I was looking to capture from my information set are being dissipated away by my size. You can basically think about like an elephant. I don't know, does this look like an elephant? Roughly. An elephant versus, let's say, a frog. Okay, probably even worse at drawing a frog than this frog has no head. If you think about the diet of these animals, and we consider, let's say, mosquitoes, the frog can eat mosquitoes, and the reason the frog can sustain themselves on mosquitoes are actually extraordinarily nutritious, very high amounts of protein to body mass. Elephants, in contrast, are going to be eating, green leafy vegetables off of a tree or something, which are nowhere near as nutritious. But the thing is that an elephant is not properly equipped. Think about how many mosquitoes you would need to feed an elephant to sustain an elephant. And the answer is, by virtue of its size, it cannot find an adequate supply of nutrition in this form. A frog, because it's small, can go after the best investments, in a sense. So you could think about this as being a small fund and a large fund. And the large fund acknowledges that this little tiny, startup company is a good investment, but they could only ever allocate, 0.001% of their capital to it. Whereas maybe this small fund can put 1% of its capital into that. And so that means that could be a relatively large contribution to the overall performance of this fund, whereas here it would be almost non-existent. It's probably not even worth the effort in acquiring the necessary research and information to decide, is this a worthwhile investment? They know it's too small, so it's probably not even worth the effort. They won't even go after that. And so the Kremer's Petagisto article is not really addressing size in the sense that it's contributing anything to that conversation. It's not really. What they're trying to do is make sure that other academics reading this paper don't say, what you've done is you've discovered something that we already knew. We know that large funds tend to be more passive. Okay? Whereas small funds, because it is cheaper for them to get in and out, they don't bleed as much information, they don't have price impact, they're more active. And so the concern would be, is it the case, whatever pattern we find where they talk about quality, this paper is going to make the argument that activity adds value, and an academic could say, it's not that activity adds value, it's that small funds add value, and small funds just tend to be active. And so the reason that they split the table two ways is they want to show that staying with a certain size and looking at variation of activity, there is a performance difference. Okay, so let's clear this mess up and actually have a look at what this table is saying to us. Okay, so in this case, let's say, starting with the smallest fund. Okay, these are all small funds, and just looking amongst small funds, nothing else, what pattern do we observe? And so what we notice is that amongst small funds, highly active funds are generating, and what's this number? This is an alpha. They ran a regression where they did the expected return on the fund is equal to the risk-free rate plus, and then they used the Fama-French model. Okay, so you have your CAPM factor, and you have your various other factors, your HML, SMB, etc. SMB, HML. Okay, so when they run this regression, there's going to be a little bit of an error. There's going to be that persistent gap, this abnormal return. This is your alpha. And so what they're reporting here, this is the alpha of those funds. Okay, so what we see here is that amongst highly active small funds, the alpha is 1.71%. In contrast, amongst the least active small funds, the alpha is minus 2%. That's a total difference, in fact, if you take high minus low, that's a total difference of a 3.7% difference. Not based on size, based on activity. That is, the least active small funds are underperforming the most active small funds by 3.7%. And then in the brackets, what we're looking at here is the t-stats. So t-stats are related to p-values. I don't need you to memorize this for the exam. I'll present my stuff in p-values to make your life easy. But to give you a sense, these are the numbers that you saw in your stats class. I think you would have seen like 1.63, 1.96, 2.33. Do you remember seeing these? These are the confidence measures that would be like 90%, 95%, 99% confident of your various hypotheses. Okay, so what these were counting, these were your t-stats here. And they're associated with a certain likelihood. This is going back to the stats that we've already described in the class, right? So if you imagine a normal distribution and you're starting at the mean and you count over, let's say, 2.3 deviations, so 1, 2, and a bit, then the tail remaining area would be only, let's say, 1%. That's your p-value, okay? So why am I talking about this? Because a 3.7 T-stat is actually quite significant. This is basically saying they're highly confident. If you trust the model, you trust the Fama French, you trust their method of creating activity, you trust all these things, all these caveats here applied. It really does look like active funds are generating a terrifically higher return, significantly so than inactive funds. Okay. Incidentally, we did talk about this before when we were talking about the other article, when we were talking about the Cuthbertson article. I said, look at where the papers are published, because that itself is a signal. This is a review of financial studies. This is one of the top 3 journals in finance. Okay, so this is an A+ student. This is RFS, Review Financial Studies, the Journal of Finance, JF, and then JFE, Journal of Financial Economics. These are our A+, publications in finance. These are the good guys, bright boys, ones from Harvard and MIT and all the rest. So this is a significant result. It's being done carefully by a good quality, researcher. It's also reasonably recent. I mean, it's 10 years old now, but still not ancient history. This is a reasonably recent analysis. And so there's a good indication that activity matters. Now, the question is, does that hold up if we change the size of the company? So if we look at, the size of the funds. So if we look at one size category up, so these are small funds, but not as small, we still see a huge difference in performance on activity. It's still very significant. As we, the pattern continues. If we go all the way up to the largest fund quintile, so this is the largest 20% of funds, you can see that the difference now is not so significant. It is still positive, but it's not reliably significant. But what we can conclude is that amongst the largest of funds, there's no real difference between active or passive. It may not be beneficial, but it's certainly not harmful. And if we go down just one quintile, down to the 80th percentile in terms of size of fund, once again we see that the alpha is positive and it's significant. Okay, positive and significant, very positive, very significant. So it basically says, if you have a choice, if you're going to invest in any of these funds in terms of size, unless you're investing in the absolute largest of funds, if you're investing in most 80% of the funds out there, except for the giants, you're better off really having an active fund, because the performance is going to be quite a bit better than their low performance their low active counterparts. Okay. And so this relates closely to, it's an interesting idea that you can observe what the managers are doing. The prove it to me statement, they say, I say, are you good? They say, yes, I am. And so I say, prove it. And the manager effectively says, look, I'm willing to break away from the herd. I'm willing to avoid the strategy that's safe for my career, because I'm so confident in my capacities as a manager that I believe that I can deliver good returns, and I'm willing to risk my career because I potentially expose myself. It could be the case that by deviating from my benchmark, from my comparison group, that by going out and on a limb like this, you could discover that I lack skill. But I think I can risk breaking away from the herd because I possess skill. Okay, and so one last little thing just to cement all of this, and it's not finance, but it's it's an interesting little story, interesting story for me. At one time when I was doing my PhD, I was sitting outside of a grocery store and I saw all these pigeons up on the roof. I'm sitting on a park bench, just bemoaning my existence as a PhD student. What have I done to myself, and why am I trying to acquire this signal? And so I'm looking at these pigeons, and there was a person who came out and they decided to drop a bunch of breadcrumbs on the ground. And so what happens is the pigeons, of course, are all looking at this pile of breadcrumbs on the ground intently, and eventually one pigeon flies down. Now, if this was a trap, if there was a cat here, or if there was, that wasn't real food or something, then the first pigeon to fly down is the one that's going to get picked off, right? That's a highly risky strategy. Pigeons hang around together. There's security in numbers, right? If a cat somehow got up on the roof, the chance of it killing any one pigeon in this case is 1 in 5, right? I mean, they have security in numbers. If you break away and you come down here, you're the only one that the cat can grab. You are definitely dead meat. However, if you trust yourself in that you trust that your environment is safe, that no cats exist, and you trust yourself that this is some kind of beneficial opportunity which is short-lived, the ones that go down soonest will become the fattest pigeons. right? They will be the ones that benefit from their superior information or their superior conviction in that information, and they will become giant pigeons because they have successfully acquired this food. And incidentally, what's interesting is that if you watch pigeons, I don't know, maybe, they are flying rats, but it's kind of fun to watch their behavior. Once one goes down, you'll notice that the other ones are much more inclined to follow. Because what's happened is this one has indicated his confidence or her confidence that there is benefit to be had here, and they've also reduced the likelihood that if there is a cat, the probability of failure goes down. And eventually what occurs is if enough of the pigeons go down to the roof and you have just one pigeon left, it's actually most risky to stay where you are if you're not confident, because now the flock is down here, right? If there's no pigeons up on the roof anymore, they're all down there having a feeding frenzy. Then if there's a cat, you're facing the greatest risk up here, and you're missing out on a potential meal. So you'll head down anyway. However, you're a latecomer. You probably will miss the potential benefits, or what, in this case, abnormal returns. If you see a good investment available and no one else is touching it, it's risky to go and put an allocation into it. You're taking a chance of exposing yourself as a nincompoop for thinking that company was a good investment. But if it turns out that you're right, and you do that reliably enough, and you're not picked off by a cat, that is, you don't destroy capital and suffer serious redemption, then what will happen is over time you will gain the benefits. You will become the largest pigeon on the block, and other people will follow you, and you will extract abnormal performance over time and basically establish yourself as having a positive alpha. Okay? And so I think that ends this slide. I'm just going to look to the next one. So we're at efficient market hypothesis, but I believe this would be about the length of a normal lecture. I think I will do this one on the second method, which I did say I believe will be Zoom. They have another software package that they're going to try. So it probably won't be YouTube. Details will be forthcoming once I have them. All right, so happy reading. Get started looking at the past exams. At this point, what you can do is you can do Bayes' theorem problems. So please start practicing that immediately. You can do the asset pricing kernel questions, which is going to be one of your short answer questions, definitely, and it's an important component. You can do some stuff on information as well and on signaling. So if you were to ask me how much do I think you've covered of the final exam, these last few lecture slides are really quite important. So I would say please get started on this right away, because in terms of percent allocation, I would guess that looking at it, I'd probably say about 40% of your final exam, maybe 40 to even as high as maybe 50% of your final exam will be on just these topics. So if you can get these started, then you're gonna have a good leg up getting ready for the final. Okay, so look at past exams, send me emails if you like, and stay tuned for the next presentation on efficiency. All right, and we will talk next week.